No, go away. Okay, now where'd my thing go? Where'd my Google go? There it is. Okay. Futures. There we go. Let's see how everything's doing. All right. So anyway, so there's obvious inflation, and this is where it's tricky in so many ways, right? Because Campbell's is trying to make you a soup, and they've got to worry about the cost of the can. They got to worry about the cost of the shipping. They've got to worry about the cost of printing the label. They got to worry about the cost of the labor that makes the stuff that puts it in the soup, and so on and so forth. And they got to worry about all the ingredients that go into the soup. And when they change something, they can throw off a thing they've been working on for a long time. Like Heinz has 57 somethings, 57 herbs and spices or whatever it is they do with Heinz. I don't know what that 57 is, whatever it is. Anyway, so Heinz has X flavors of ketchup. Now, what if you make a teeny little change? Well, if you've ever had other kinds of ketchup, and maybe you're a fan, maybe not, but I mean, frankly, if you ever have other kinds of ketchup, they mostly suck, or in my opinion, they mostly suck. I like Heinz ketchup. I don't want them to change it, and so companies do stuff like that. And restaurants, holy crap, you guys have all seen this, right? Your restaurants have screwed around with their dishes. And why? Because there's certain things that just cost too much money. And it turns out that certain ingredients that maybe weren't a big deal before are now becoming a bottom line killing flourish in their business. And when you're on a scale of people like McDonald's or Chipotle or whoever, things like that matter. Like, remember when we had an avocado issue like a couple of years ago, and Chipotle's whole stock was going down because avocados are so important. And frankly, I don't understand the chicken business, because all these, first of all, the wing business is crazy because all they use is the wings. And what is going on with the rest of the chicken? I don't get that. Like, if you think about all the wing places that now exist, and they just want the wings. I imagine, there's chicken nuggets and things like that they make out of the rest of the chicken. But I mean, it just seems like a really excessive amount of wings. I just got for my birthday, I got 50 wings from the Anchor Bar in Buffalo on DoorDash, of all things. So DoorDash now has national vendors, and obviously they're not delivering it, but they're somehow shipping it or working with, or they work with these people. And so it's all like iconic places. And the Anchor Bar in Buffalo, I can tell you, that's it. That's the place to go to get wings. And I know that from my college days. And so I used to drive to Buffalo from New York to go have wings, basically. So anyway, so the 50 wings are $100. All right, so it's not like I do this all the time, but it's my birthday and I feel like having wings, and I saw this advertisement on DoorDash. I was like, yeah, why not? Let's get that. But think about that, $2 a wing. I remember 10-cent wing nights in college. When I used to get wings, they were 10 cents each. Now they're $2 each. And that was not that well. It was a long time. It was 40 years ago, but still really crazy. But anyway, different types of inflation. So as investors, we have to be worried about how badly are we being hit by inflation? How much is it going to change our business model? And ingredients can be many things. I mean, ingredients are aluminum to the electric car companies. Aluminum's an ingredient. Tesla just raised their prices 10%. The cost of their batteries, again, labor everywhere is always a problem. So you have to be very careful about the companies that you invest in aren't necessarily going to come out of this the same as they came into it. Inflation changes things and can make certain things that were easy business models unworkable. All right, in fact, think about this. We got wheat somewhere on here. gold, palladium, lean hogs, soybean, wheat. There's wheat. Oh, this isn't long term enough. Do weekly. Wheat. So wheat is coming down a bit, but I mean, wheat is normally, you know, $600–700, and now it's $1,000. And look at cotton. Think about like Levi's. What is Levi's main ingredient? It's cotton, right? So they went from 80 to 120. That's a 50% increase in the price of cotton. Look at coffee. Coffee has gone from 140 to 210. That's also 50% up. So in a couple of years, 50% is a pretty common thing. Now, you say, oh, well, so that's bad for Starbucks. It's not really bad for Starbucks because they're charging. It's the same, you know. It was 30 cents worth of coffee, and now they're using 45 cents worth of coffee in their $5 coffee. They have a different business model than Dunkin' Donuts, let's say, who doesn't charge that much for coffee. So it's going to affect Dunkin' Donuts worse than it's going to affect Starbucks. Hey, and Howard Schultz is coming back to run Starbucks. Apparently, the CEO they have, who replaced Howard Schultz, is the CEO they had to replace Howard Schultz is leaving, and so he's going to be the interim CEO while they're looking for a new guy, which is good. It provides some stability to the stock. But anyway, so for Starbucks, you got to be concerned about the price of coffee, the price of cocoa. They use cocoa. The price of sugar, which is somewhere around here, there. The price of sugar, which has also gone up quite a bit, but not terribly, about 20%. That's only 20% up. Cocoa up and down. So really, cocoa's actually in a range where it would normally be. Lumber goes all over the place. That affects the builders. You know, so even if you don't trade the commodities, you should kind of pay attention. That's why this is kind of good. This is FinViz, finviz.com, and then there's the futures, and this will show you all of what's going on, basically. It's a great summary screen. So in the morning, I always look at this to see if anything is particularly a concern. Now, that's a weekly view, but if I look at the hourly view, it gives you an idea of what's going crazy. And in this case, the markets are all up and up and up, and they've been going up since early this morning. No, I'm sorry, that was yesterday. They've been going up since yesterday morning before the market opened, and they only stopped because we closed, and then they start going right back up again. Everybody's very enthusiastic. The S&P is right at, well, actually it's at 42.99. Remember, they had to be at 43.20, and they're at 42.99. So 43.20 failed, and that's actually not a good thing. So we'll see what happens. That was the strong bounce line. So we poked at the strong bounce line and failed. That's actually worse than not even getting there. See, if Russell 2000 fails and whatever, all they're going to be doing is proving that the markets are weak in the end. It's not going to really be a sign of strength if you just go back to the bounce lines and fail it. And the bounce lines are la 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 la. And don't forget, you can't, you know, you have to take the whole day with a grain of salt, because China just basically said they're going to support the market. So if China tells you they're going to support the market, that's, you know, just the same as if Biden says he's going to support the market. It's the world's second largest economy saying they're going to support the market. And there's no details or anything. They just a statement made by a minister today. But that's all it takes, because it's a squeeze thing. It's basically people start running back into stocks, and the shorts feel obligated to get out of their positions, so they end up becoming buyers as well. And that's how you push the stock market back up. It just takes a change of sentiment. Where were the numbers? Oh, here we are. So the Dow never came down to the 20% line, which would be 28.8 would be the low. It would be 20% off the Dow's high from 36,000. The S&P coming down from 4,800 to 4,000 is an 800-point drop. And here's the strong bounce, is 4,320. And we are now at 4,306. And the NASDAQ we didn't get to 14.1. The Nasdaq has to, oh no, it's nowhere close. The Nasdaq's at 13.7, and it has to get to 14.1 just to make the weak bounce line green. The strong bounce isn't even in question right now. And the Russell though is at 2,000. It's well above the strong bounce line. But the thing is, for a while last month, only the Nasdaq was red. And as I mentioned this morning, this isn't a 20% correction on the Russell. This is a 30% correction. But the 1920, basically this line is the 20% correction line on the Russell. So, you know, when the Russell is failing this, it's as bad as the Nasdaq. It's as bad as the Nasdaq being red here. All right, it's just the Russell already failed 20% a long time ago, so we're using the 33% line to tell us when it's getting worse. You know, it's already bad, so we tell it when it's getting worse. And you have to realize that when you look at this, he's on 100% like all the same. So it's 20% off, 20% off, 20% off, 33% off. And that's because we lost 20% a long time ago. Struggling to get it back now at this level. But if you see three things, nothing, this is a 20% correction chart. If you see anything red on this chart, something's bad. You know, when one of our indexes corrects 20% and can't go back up, that's not a good sign for anything. They were on Bloomberg, not Bloomberg, on CNBC yesterday. There was a guy, and he said Apple is 6% of the S&P 500. And I don't know. In my head, I'm stuck at 3.5. But maybe the way they got bigger and the S&P didn't get as big or whatever. But that would be crazy. But Apple is close to 20% of the Nasdaq, and Apple is a significant piece of the S&P either way. I mean, no one stock should be 5% of an index of 500 companies, and certainly no stock should be 20% of an index at all. That's just there's a flaw to the whole Nasdaq if Apple is that large in it. I mean, frankly, take 10 companies and the Nasdaq, the top 10 companies in the Nasdaq are probably the whole index, and the rest are just, you know, barely meaningful. The Dow, of course, is an idiotic index. In fact, who's splitting? Somebody's splitting. I don't remember. One of the Dow components is doing a split. Oh, Amazon. It's Amazon. So Amazon. Oh, is Amazon in the Dow? Here you go. I don't know. I don't think so. I forgot they're doing a split. That should be like the biggest thing people are paying attention to. Oh, that's not going to tell me if they're in the Dow. Sad. I used to know exactly. I used to be able to name the Dow components, and now it's like, who's in it these days? Components. Oh, come on. Boy, Yahoo really sucks these days. Very slow. This American stock could jump 1,000%. This is not even the article we clicked on. What the frick? Oh, here you go. Sorted by weight. Well, look, Amgen's in the Dow. See, I forgot about them. What is this sorted by? Sorted by weight. So the most, okay, so in the Dow, anyway, point being, in the Dow, so obviously Amazon's not in the Dow. And maybe they're doing this to be included in the Dow, because if you put Amazon in the Dow now, it would be at $2,000, it would be the whole index, because the Dow ridiculous as it seems, the Dow is a price-weighted index. So in other words, every dollar move of every company has the same impact on the Dow. So that's why these lower price stocks have lower weights and higher price stocks have higher weights. It has nothing to do with their market cap or anything else. You know, Microsoft would be on top in that, or Apple obviously would be on top in that case. Apple is way down there, the biggest company in the country, and they're down there. Why? Because their stock is $156. You know, and then poor Intel, their stock's only $45, therefore they have no weight. Walgreens, Verizon, you know, it just makes no sense. Coca-Cola, Dow Incorporated shouldn't be higher than those guys. So it's a very, very stupid index. So I think Amazon may be doing their splits so they can be put in the Dow, because that would make sense. Then they'll be at $200 a share. They'll fit in this category and be part of it. You can't add Amazon to the Dow at $2,000. It wouldn't work. So we'll see. We're actually doing a 20-to-1 stock split, so it's going to be like 150 a share. That would put Amazon back where Apple is, basically. So very interesting. But anyway, so getting back to this, so companies, inflation and such. So we just went over the butterfly portfolio. Let's take a look in the chat here. We just went over our butterfly portfolio. And this is the kind of stuff you got to think about when you're reviewing the companies, is how are they being impacted by inflation? Well, that's like unnecessarily big, isn't it? How about that? So how are these companies being impacted by inflation or whatever? So Apple, supply chain issues, right? They're having problems getting parts. Foxconn just shut down in China, so that's going to hurt them as far as getting product out the window. So nothing that they did, but they can't get parts. Now, Apple, of course, has to deal with all sorts of items. They have to. The amount of things that they have to worry about as far as components and raw materials and the cost of things and so on and so forth. But in Apple's favor, Tim Cook, that's what he used to do. I mean, Tim Cook's old job was running the supply chain for Apple, and he has done a magnificent job through this pandemic of keeping everything moving and constantly pushing his costs down, because he knows how to negotiate and work with all these vendors and so on and so forth. And that was one of the main reasons Steve Jobs picked him. I mean, Tim Cook was always in charge at Apple of all that stuff, and he's the one that brought the cost of the iPod down until they were just so ridiculously low price that people would buy them for different. People would buy one in each color because they were so crazy cheap. He's pushing the phone prices down, but more to the point where they're just keeping the price basically the same on the low end models, and adding just so many features that they're mind blowing for the price. But eventually he'll start grinding the price down too. So Apple does a good job of controlling costs, and long term, nothing to worry about. Here's our boys at Amazon. They're going to do their split, but there's nothing weird going on, so we're just going to have a split stock. And obviously Amazon is Amazon, and you can't get away from that. So BDX, we just added them. Nothing particularly concerning inflation-wise or supply chain-wise here. Disney, you got to be concerned about the shutdown in China. Is of course shutting down the Chinese park again. And then if that spreads, they could blow another summer. So things could be bad, but still long-term, the parks. Here's the thing. This could go wrong and that could go wrong, right? But that's the reason that you don't fly or go in a submarine or do a lot of things. It's like things could go wrong. But if things don't go wrong, Disney is a monster. Their parks are completely sold out. They have doubled the prices in the last few years on pretty much everything, from the tickets to the water. You know, everything in Disney is gone crazy. The price of the hotels at Disney have gone crazy, not even including the Star Wars hotel, which is like $5,000 a night. Everything has gone nuts. There's only 100 rooms in that Star Wars hotel. I guess the whole thing is just to create to create the scarcity. Oh, which by the way, holy crap, they were talking about that. John Oliver was talking about that with Ticketmaster. And I didn't know that before, that, you know, when you hear a concert, and I thought about that mathematically, when you hear a concert sells out in 5 minutes in a 60,000 seat arena for 3 nights or something like that, 180,000 tickets, you think, how did that happen? I don't care how many computers you say you have and so on and so forth. That just seems unrealistic that it's going to sell out to that extent that quickly. And the reality is they don't sell 180,000 tickets through Ticketmaster. They only sell 20,000 tickets through Ticketmaster, and the rest go directly to various outlets like scalping sites that they hold off for the secondary market. So they're purposely creating the scalping system, and it's just a horrible, dirty, disgusting business. So anyway, if you get a chance to look at that from John Oliver, he's talking about the fake scarcity. So Disney does that same thing like the Star Wars hotel. It's a fake scarcity. Disney is now limiting, and again, brilliant. They limit the amount of people who can be in the park because of COVID, and then they realize that by limiting the amount of people that can be in the park, people are freaking out to reserve early and spend as much as they possibly, you know, spend whatever it takes to be at the Disney hotels so they don't get shut out. So if you're at the Disney hotels, you're going to get into the parks. If you're a walk-in, you may not get into the park. So if you want to go to a cheaper hotel and then try your luck getting into the park, they're like, well, good luck. But the people who are staying at the Disney hotels have their park reservations too. So Disney is masterfully doing this, and they're horrible, horrible people, and they're turning off. A lot of people are turned off to this, but it doesn't matter because they don't care. They're not doing it for Mr. and Mrs. Middle America anymore. They're doing it for the ultra rich. Disney is now a luxury experience for ultra rich people, and they frankly don't want the average people walking around. It annoys the rich people. They want all clean, well-dressed, you know, people going around with well-behaved children and so on and so forth. You know, they want an antiseptic park that people are willing to plunk down $200 a day for. Anyway, so we invested it because they're raking in the money. Ford had a nice, I mean, you know, it's a horrible pullback if you care, but we don't care because this is right in our investing track. They were runaways at 25. All of a sudden, nobody believes in them at 16. And of course, yes, supply chain difficulties, inflation, so on and so forth, but nothing that's going to give them a disadvantage as a competitor to anybody else. It's the same problem for the whole car industry. So, and people have to buy cars, and also there's been a 2-year sort of hiatus on people buying cars. Car sales were very low for the last couple of years. That means there's a lot of pent-up demand. Not to mention electric cars coming online, so on and so forth. So we're not worried about Ford. It makes it a good opportunity to buy more, not to get out. And so what we did is we bought back the short April 20 calls in case they pop back quickly. Got all of March and part of April, got half of March and half of April, got another month. And the last month, they did this. So it's not about that we think it's going to go back, but the April 20s are down to some small amount. Where are they? Ford, April 20s, 9 cents. So for 9 cents, there's no point in us having these things, because if it pops, not likely, but if it pops, all it's going to do is make them more expensive. Then we're stuck and we can't get out. This way, if it pops, we can quickly sell something and cover and not be worried about it, not be worried about having too many short calls, and we get back on the profit machine. Genworth. Now, here's a nice industry because they only have to worry about the labor costs. They don't really have they don't have a hard products. They're not buying materials or anything like that. They just got to worry about their labor costs and their financial costs and so on and so forth. In a rising rate environment, they should actually do very well. They have reserves that they have to invest in, and it's obviously on the base rates for bonds and so on and so forth. When they improve, it's great for them. So we made an adjustment there. Gold, great inflation hedge, but who knows if peace breaks out, we may drop a bit back. So we're taking advantage of this and doing some selling right now, selling some short calls. IMAX, again, it's a non-material thing. They build theaters, but it's not consequential to the whole, to what they do. So, and frankly, IMAX doesn't really have labor costs. Again, they build the theater, but they're more like a hotel. They're like renting what they build, not selling it. So IMAX, as long as movies come back, as long as we don't have another big worldwide lockdown, they should be doing very nicely going forward. So we're very happy with these guys. So what we're doing is we're letting the short calls we did sell expire, and we're going to wait until they pop again, and then we'll sell some more calls. Now, Coca-Cola, this is going back to now you got your commodity concerns. What are they spending money on? And again, remember what I said, Coca-Cola doesn't buy sugar. They buy corn. Where'd that go? Here it is. Coca-Cola doesn't care about the cost of sugar. They care about the cost of corn. Fortunately, where is it? Corn. There you go. Fortunately, in the US, we have unbelievable amounts of corn. We export tons of corn. We have corn coming out of our asses in the US. So even when everything else is going up, corn is just subject to whatever the crop situation is in the United States, because we are a massive exporter of corn and a massive consumer of corn. And the reason we have corn syrup and everything you eat for breakfast, all your cereals are corn and so on and so forth, it's because and we feed all the cattle with corn. It's because corn is super abundant and cheap. It's like ridiculous how much corn this country has. So that's more important to Coca-Cola than sugar, which is over here. And sugar is actually coming down too. So you think about like what it is, and now tin cans are a problem for Coca-Cola. The aluminum costs are going up tremendously, but how much tin are they really using in a can? What percentage of a can of soda is the tin content for them? So if you think about it, you're buying Coke for maybe, what is it if you buy I don't know what it is now. I remember it was 3 for $10. And you get 3 12-packs for $10 at the supermarket. I don't know what the price. I don't buy it anymore, so I don't know. But I have because I don't have the kids with me, so I buy soda like really rarely. So what does that work out to? It's $3.30, about 35 cents a can, basically, is the retail price at the supermarket. So, obviously not the 7-Eleven price or anything, but when you're actually buying it on sale at the supermarket, it's about 35 cents a can. So how much could the aluminum content really be? It's probably, so maybe it was 5 cents and now it's 7 cents for them. It's not a killer. Obviously that matters. If the profit was only 4 cents on the can, it's half the profit, but I'm sure they raised their price, and you probably can't buy three cases of Coke for $10 anymore either. Where were we? So there's Coca-Cola. Here's MJ. We brought back the April calls just because they ran that course, but we don't. I'm hoping that it kind of does what it did here, and it gets back in favor, but we'll see. But again, don't forget in the butterfly portfolio, these aren't long bets. These are just bets where we sell premium against them. Although right now, since everything's sold off, we're generally getting more bullish because we expect there to be some kind of a bounce. And here's Unilever. And again, they're back to where they had good support and the buying spree went on. So we're buying back the short calls and waiting for the bounce on these guys. And Walgreens, we think that 45 is a good floor, so we're buying back again, buying back the short calls, waiting for pop. So in this case, if we're wrong in the butterfly portfolio, we're going to have to scramble and do a lot of short call selling. But if we're right and things kind of bounce back up on these stocks, then we're still going to do some short. Either way, we're going to do some short call selling. The question is at what strike, basically. And here's Whirlpool, where we open that up also to rise. So I think, and now Whirlpool, of course, massive supply chain issues. The cost of steel and the cost of aluminum and a lot of parts and so on and so forth, and the labor in the factories. They've got many concerns, but they've been navigating it great so far. And they're a super solid company. They've been around for 100 years. Not too worried about that. So, if the market is going to hold at these levels, if we're going to hold these 20% lines, and again, my premise for us holding the 20% lines is that I think the government, I know the government has another round of stimulus in them because Biden's been trying to pass the stimulus bill for 2 years, and they won't let him. So what's going to make the Republicans capitulate? Obviously, a stock market rout is going to make just like China. So, you sit there and say, oh, these politicians, they don't care about this or that. Yeah, they do. The frickin' president of China, who has complete control of everything, just capitulated because the stock market was crashing and people were starting to lose jobs. So he changed his policy and added stimulus. You have to. In China, he's worried about having a revolution in his country. You start having tens of millions of people out of work in China, and they got nothing else to do but riot in the streets. It's a problem. Oh, I was going to check the EI. Okay, we'll check that next. So anyway, Whirlpool, right? So Whirlpool, very good at navigating through these things. So long term, we like him as an investment. And like I said, I think we have another round of stimulus coming. If things get worse, there'll be stimulus. If things don't get worse, obviously, then we're fine here too. So at this base, as we're approaching 20%, as we feel these stocks are starting to bottom out, it's a good time to start making some bullish bets. So we're making a few bullish bets. We'll see how he goes. But again, what did we do first? The first thing we did was check our hedges, and our hedges are huge. We have $1 million worth of hedges. So we're not taking a huge risk, and we have a lot of insurance just in case we're wrong. But we want to sort of make a few bullish bets at this point. Let's see what we got people saying. Brian says he's waiting for an update on the PSW. On PSW investments, I guess. Yeah, okay, Brian. All right, I'll get on that. I'm gonna get that dealt with by the end of the month. Let's see. Bruce said, terrible. We discovered a coral reef small batch orange juice at Publix. All right. So Brian says that coral reef small batch orange juice at Publix is good. Okay, I'll check that out. Environmental groups should ask governments to create standard size containers and help save the environment. That would be good too. Rick says Costco sells a bag of juice oranges for less than $5. We have a juicer at home, but it's no, thank you. It's just no. I liked it because they had a great big machine that did it for me, not because I want to go home and deal with that crap. We do get great oranges, but I'm just not going to sit there and squeeze them. You get that. It's sad though, when you watch this machine at Amazon, it's sad how many oranges you need to to make some juice. It's like 40 oranges to make a half gallon of juice. It's crazy. Bruce says soup sizes have also shrunk. And he says, why don't they sell an unsweetened Coke, charge more, be more healthful without added sweetness to the ingredients, and they don't have to add the calories? An unsweetened Coke. I think a Coke is like half sugar or half whatever. I'm not sure what an unsweetened Coke would be. Basically, ew. I don't think that's going to work. Conspiracy theory. Can increasing commodity prices be the reason for Putin's war being allowed in the Ukraine? I don't think so. I don't think, well, there's always something. Look, Putin's war in the Ukraine is doing wonders for Putin's bottom line, selling oil. He's still selling his oil. He's just not selling it to NATO. But other people are buying his oil. India's buying his oil right now. They're like, oh, you want to sell your oil? Sure. We need oil. That's a problem. You can't, if you can't get the whole world to do sanctions, these guys are going to find a place to put their oil. And he's obviously selling it in Russia. Just like America, we produce, what's the number? I think we produce like 13 million barrels of oil or 12 million barrels of oil a day, but we use 20 million barrels of oil a day. So it doesn't matter. We sell all the oil to ourselves. Russia is the same thing. Although Russia probably sells 80–90% of the oil that they make to themselves. The Russians buy it. They don't give a shit if you don't buy it. It's not their problem. But the problem for Russia is, though, if the economy crashes, they're going to use less oil. But it's not like, it's not like you're killing Putin by just saying we're not going to buy your oil. They don't export that much of their oil. Amazon is not in the Dow, but Amazon is doing 21 split. We talked about that. You clicked on an ad instead of the components. Oh, is that what I did? See, I'm sorry, I get to these questions a little bit late, right? Wayne says, when did GC pull back? What factors will drive gold? What factors will drive gold higher? Inflation, real interest rates? Look, gold didn't pull back. It just is going up. Where are we? Yeah. Metals. Gold. See, gold, this is not pulling back. This is consolidating for a move higher. 2000 is significant resistance on gold. We hit it back at the beginning of the year. We pulled back, and look, here's your running gold from basically 1250. So 1250, and what's 50% more of 1250 is like 1850, right? So let's say 1850, 19. So 1850, 1900 is your run to gold. So 2000 is already a bit of an overshoot. 1950 is where you're running from 1200. So if you want to call 1200 a base and say 1800 would be the next 50% move, that's where you are. So what are we doing? We're consolidating at the 50% line, and you've got to consolidate like we did at 12 for the next move higher. In fact, let's zoom out even more. So see this? Here's 250 gold. Here's 400, some consolidation for a couple of years. Then you're making a big move up. Now you're going to 600. That's a 50% move, consolidation. Okay. Then 50% from that is 900, consolidation. Okay. Then 50% from 900 is what? 1350, right? See the consolidation that goes. Now you had an overshoot, but you see the consolidation goes on for years. And then you're coming up back to, now you're consolidating around this part, around 1950, which was where you shot up to here. That was an overshoot, of course. And now you're here. So we could do this for a very, very long time, but eventually you're going to see bigger numbers. Why are you going to see bigger numbers? Because inflation, overall inflation, is real. And there is only, just like a Bitcoin, there's only so much gold in the world that will only ever exist. Except unlike Bitcoin, gold is a physical, real thing that you hold in your hand. And people want it for other reasons. It has a value unto itself. In other words, gold, when gold was $250, my argument for gold was at $250, it's worth using as electronic components. the improvement of your electronics at that kind of price when you're only paying $2.50 an ounce for gold. So in other words, you think about what your iPhone weighs. Your iPhone could have an ounce of gold in it for $250. It's a freaking $1,500 phone. So if gold were $2.50 an ounce, everything in your iPad could be made of gold, all the components, and it would be a big improvement in performance. So not to mention the fact that for $2.50 you could have a gold-plated iPhone. You know, that could be a standard thing they do. So at a certain price, certain things are desirable enough that you want to do it. In fact, a couple of years ago, in these years, in like 2015, when gold was around $1,200, a lot of fancy restaurants I went to were putting those little gold specks on things. It was a big fad for a while. Like everybody's putting gold accents on the food, and that has died. That's gone. So that was it. We were a victim of that. So, you know, again, it's 50% higher. People start rethinking what they're doing. It was a fun flourish when it was $1,000 an ounce. And these shavings, you don't realize it, like, and you eat them. You know that. I mean, I don't know. I'm sure not everybody goes to kind of places where they do this, but you know, when they put a little bit of like a little gold strip on the chocolate, you eat the gold, which is weird. But when you do put it on your mouth or you touch it, you realize it's just so incredibly thin. But that's one of the properties of gold that people like about it is no matter how thin you make it, even like a molecule thick, it still looks like gold. And that's what they're doing. They take these incredibly microscopic shavings in thickness and putting them on stuff. So the weight of it is you can't even weigh. It's like not even measurable weight. And so an ounce of gold will last them like a month or 2 months of decorating their desserts. Even sushi though, the place up in Jersey, they had one of their tuna belly roll came with had gold flakes on it, and was $20. But you know, it wasn't the gold, it was the tuna belly that made it expensive. Anyway, so you know, this is just normal consolidation, and you know, the question is, will inflation back off? And no, of course not. Inflation doesn't back off. We don't go backwards. When in your life, when in anybody's life have prices gone backwards and everything got cheaper over a 10-year period? You can have a recession or a depression and things will be cheaper temporarily, but you generally go back and things start normalizing in prices. And over the very long haul, that's just not realistic. So things will get more expensive. The dollar will devalue. All currencies will devalue. People will still buy gold. And there's only, I want to say, not tons, there's, what's the number? It's certain, how much gold is in the world? There you go. How much gold is in, okay, gold reserve. Now, see, that's tricky. That's not the answer. How much gold has been found in the world? There you go, 244,000 metric tons of gold. But the thing about gold is heavy. So there you go, that's a good one. See, these are meters. And this is very freaky because people don't understand this. This is all the gold in the world. Basically the same 250,000 tons, whatever. But the 250,000 tons, there's man. This is 21 meters tall, 21 meters wide. So 60 feet tall, 60 feet wide. That's all the freaking gold in the world. This is all the gold that can be excavated from the ground. And that's it. We're done. Oh, here you go. Here's another one. So that's all the above ground gold in the world. That's how big it is. So when you wonder why gold is considered valuable, the thing that makes gold valuable, here's what makes something valuable. The thing that makes gold valuable is it's verifiable that it's gold. There's chemical ways that are not that difficult to test and verify the purity of gold. And therefore, if you see a piece of gold of a certain weight, you know exactly what it's worth. You know exactly what you have and what it's worth. And it's an easily transferable physical thing. So it's useful as a currency, basically. It can't be duplicated, it can't be created, it can't be counterfeited. You can't fool people. Gold is gold. That's why it has value. Now, a Bitcoin, there's only 21 million Bitcoins in the world, not all mined yet, but there's only the same thing. There's only 21 million Bitcoins in the world. And you have a similar situation, right? You have 21 million Bitcoins. They are verifiable and countable. But the difference between gold and Bitcoin is gold has actual uses. And that was that, where was that chart we were just looking at? Gold has uses. 47% of all the gold that's ever been pulled out of the ground has gone into jewelry. 21% has gone into vaults. 17% has gone into private vaults, public vaults. I don't know what other gold means. I don't know what people, oh, probably the gold I ate and flushed down the toilet, right? It's like 14% goes into food or whatever. But that's it since the dawn of time. All the gold, people chasing gold, their whole, the history of humanity chasing gold. We conquered nations looking for gold. That's all there is. No wonder people have to work so hard to get it, right? It's a lot easier to mine Bitcoin. You can't mine gold sitting in your living room playing with your computer. So, when you look at a vault like this, right? It's not that much gold. And here's big stacks of gold also. This is a thing. But think about it, because it would be 60 feet high. This is only what, 6 feet high. So it would be 60 feet high and 60 feet wide and 60 feet in a cube. That would be all the gold. So what the hell are we talking about? Oh, so anyway, yes. So the point about gold is, and it's getting harder and harder to mine. Just like a Bitcoin, that's interesting too. That number's pointless though, I'm sure, because God knows when they wrote it. That's it. And the funny thing is, think about how much gold is in that pyramid. But that's what I'm talking about. Most gold is plated, and they mat it, they pack it down and they spread it over a very large surface area. And it doesn't, when you spread gold and plate it, it looks like everything is gold, like the whole thing is gold. But most things you see that you think gold are covered in gold, not really gold, not solid gold. And that's why gold is impractical as a currency. People keep talking about, oh yeah, everybody can switch their currency and being gold. No, you can't. You can't back your currency in gold. There's not enough gold in the world, and you can't make it, and you can't fake it. That's why Nixon took us off the gold standard, because you can't fake it. You can't back your currency in gold. It limits your currency. It limits the growth of your country. You can't grow more than you can put gold in the bank, in the vault, and you run out of gold, especially with inflation. So and here's the thing, will gold then be replaced by something else? Will there be another thing that we chase around like that? No, because gold is gold. Gold has just got that, it's got so much going for it, right? Because it's pretty and it's useful and it's verifiable and so on and so forth. It just hits every possible spot, and that's why every civilization on Earth values gold independently. They independently came to the same conclusion that gold is the best. Right? Like the Aztecs figured it out, the Chinese figured it out, the Japanese figured it out. Everybody loves the gold. The Egyptians figured it out. Gold is big. Gold is king. Gold coins, gold this, gold that. That's the apex predator of currencies of wealth storage. So, so it's just history. It's just over time, gold is going to go up. You just are being impatient. You just don't want to see any dip at all. but that's just not how it works. You know, back in, I can't believe how much it is. So in 2004, and I knew that at the time too, and gold was at 9/11, that's right, it was after 9/11. After 9/11, gold was 250, and I was just, I just said to my guys at the time, I was like, you know, we should just like, that's it, because again, 250 was the price at which you could actually, that it made sense to use it in most electronics, that whenever you had a chance, you should use gold. So at 250, I was just like, you know what, guys, we should just like just put everything into gold, because just forget it. That's all you have to do for the rest of your life, because you're never going to lose the value. It's always going to go up. Now, 20 years later, at $2,000, is that an appropriate gain? This was an inappropriate gain. This was too high. But now 20 years, so 10 years later, $2,000, that was a failure. But 20 years later, especially in light of actual inflation of 8% a year, 7% a year, how many years does it have to be 7% before it's justified? Well, if you're starting out at, if you're saying that the base is 1,200, 1200 times 1.07 times 1.07 times 1.07, 3 years inflation, 1.07, 4 years inflation, 0.07, 5 years inflation, 1.07, 6 years inflation, 1.07, 7 years inflation. Is that right? Seems too slow. 1200 times 1.07. Oh, I think I must have hit a plus at one point. 1.07, 1.07, third time, 1.07, fourth time, 1.07, fifth time. Yeah, that makes more sense. Sixth time, 7 times, 1.07. There you go. So 7 years of 7% inflation is going to get you to 2,000, and you can't go back. Minimum wage was $7 an hour. Now it's going to be $15 an hour. That's going to drive the cost of everything else. Unless you start making it without wages, you're going to be having to increase and pass all those costs along through society. And things were underpriced. We were underpaying the labor force for a very, very long time. And so like the Southern plantation owners, we now have to recognize that you can't pick cotton for free. You can't get 100 people out in the field picking your cotton that you don't pay. You have to now come up with a realistic price for your cotton that takes into account the labor. And that's what the minimum wage is, right? You have to somehow account for the labor. You can't, restaurants also having to reconcile this now. You can't pay people $1 in a restaurant and say, oh, you live off tips, so I'm only paying you this token amount for the government's sake, whatever the reason is that they do pay you $1. And they got to show some kind of wages and taxes or something. And that's that practice is being frowned upon. By the way, speaking of inflation, what is this bullshit now where no matter where you go, every you're just every fast food, everything you go to a counter, anywhere you go to get anything, they want a tip. Now you have to tip for everything. That's crazy. I mean, and it wasn't that bad a few years ago when they started doing it, because everybody was happy and secure economically. But now with food prices going up and everything going up, and this tipping thing has become an epidemic. And God bless them. I mean, it's nice that they're getting some good wages for their work, but I just wonder how much these counter people make these days. I really don't know, but I mean, geez, what a change, right? I mean, it's so weird that you take, and the defaults are obnoxious. One restaurant in my town, where they, not a restaurant, well, it is a restaurant, I guess. But anyway, so one place in my town, they have a default of 7%. And I think 7% is very fair. I don't mind paying 7%. Some of the places have defaults of 20%. And I'm sorry. I'm a nice guy. I'm a generous guy. But for you to hand me a slice of pizza and I have to pay you 20% tip because you handed me a slice of pizza at a counter that was supposed to be, that was supposed to be $3 and now it's $3.60, or whatever it is. I mean, it's actually in Florida. It's crazy with the taxes too. I think it was like I don't know, it's at least a 10% tax on top of it also. But it's just a nickel and dime you on so many different things, and all these automatic payment systems, they stick the tips in. And I won't be surprised when they start doing it at retail stores too. So like, again, more inflation, more inflation, more inflation. That makes me have to go to my boss and say, give me more money, blah, blah, blah. And then wages go up and costs go up and this and so on. It's just a very vicious cycle. Oh, the Fed. Okay, let's just get to that 25-point rate hike. Thanks, Brian. All right, well, we knew that was going to happen. Let's see, who else asked a question? Wow, you guys are really active today with the questions. Why is gold pulled back? Gold corn is subsidized. Yes, it is. Lebu, time for a spread or wait for the next leg down. Lebu, we're just waiting and seeing what happens. Randy says, Phil, with the massive increases in single-family housing, what is your outlook for real estate in the next year or two? Well, I'm not sure what you mean by the massive increases in single-family housing. That's the question. You mean the cost increases of single-family housing? I just think, look, they're becoming unaffordable for regular people. It's a big problem. The government's going to have to step in with some programs, but we need a housing crash at this point because people can't afford this shit. And if the rates rates, by the way, rising rates make the homes much more expensive. You don't buy a home, you buy a mortgage, and you pay for what you can afford. So when they raise the rates and you're paying a lot more per month in interest, you just simply can't afford the house for these prices. That's why there's very low inventory on the market. As other people don't want to sell their homes, it's that usually before you sell your home, you go find the home that you want to buy next, and people are getting complete sticker shock on the homes that they want to move to. So they just stay in the home they're in. You don't want to give up the mortgage you have. People just staying put and moving less, and that's causing a problem. It's a big problem for the home builders. I don't think housing is a very good sector right now. I think, I think that we need a shakeout in the market, and I think it's going to happen because it's just unaffordable. People don't have it, and also, COVID and the recession and so on and so forth. It's robbed a lot of people from having the kind of money you need to make these deposits. And of course, of course, the bank's not going to qualify you because you need more money to pay your mortgage. And that's not even counting the fact that the municipalities are going to have to start raising their taxes. So property taxes are going to go higher as well. A lot of bad factors for the housing industry coming up. Bruce says, I have Top Trades membership, but have bought other suggestions from other portfolios, but I feel I don't see the updates. What should I do? I'm not sure what you mean. If you only have a Top Trades membership, you're only going to see the top trades. The other stuff we talk about in the chat room, and you need to get a basic membership for that. There's no fix for that other than getting if you're going to play the other trades, you want to get a membership for those trades. I'm not sure how you bought the other member. I guess maybe if you saw them in the portfolio that we reviewed or something. But we do these every month. We go over this stuff. Bruce says, I used to trade the futures a long time ago. Well, again, Bruce, you got to be a member. So, if you, yes, I'm happy to explain. You just ask me in the chat room. Wayne says, if peace in the Ukraine is declared and or U.S. stimulus happens, can you guess where gold will pull back to? Yeah, I think that you're going to get a good support for gold on this. Shoot, hang on, the questions are in the way. I was, before this started, I thought 1850 was a very good support line for gold. It didn't always hold up, but I feel that 1850 is the right price for gold given the current market conditions, and I don't think that's going to really change. I mean, on a big pullback, we can obviously go back down to here to the 1700 level basically, because that's where your next clear support is. But it's very, very strong support here. But at 1850 is where I start buying gold, and below 18, I've got some serious conviction to hold it. I think gold is just really should be about 2000 or higher and heading to the next level up, which is going to be 24 after this. But again, when I say after this, that means this is 10 years. So the next legs up head to 2400 in 10 years. How it gets there, I have no idea. But this war is a pump up, but it's only the reason or the excuse of the moment for gold to pop up. But inflation is here to stay. It's not going anywhere. Bum, 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 bum. And Randy says, and the rent costs. No, the rent costs, Randy, are way worse than you think, because what's going on in the rentals is the venture capital people have all moved into the rental business, and they're using algorithms like, kind of similar concept to oh, I forgot their name now. The guys who value the housings, whatever they're called. The guys at Zillow, that kind of thing. They running these algorithms on the rents and what people can afford and what can be priced and so on and so forth. So they're maximizing, like Ticketmaster, they are maximizing what people can afford to pay. Not what you want to pay, it's whatever you can afford to pay. They are engineering those prices in the neighborhood. Because a regular landlord who owns a building can't afford to kick all the tenants out. In other words, a regular landlord can't not renew all the leases in the building, leave it empty for 6 months so he clears the rent restrictions laws, and then refill it with much more expensive tenants. Even if it makes complete sense in a business model, just doesn't have the cash flow to do it. But these venture capital investors, they run a spreadsheet and they say, hey, look at this. This landlord guy has a building and he's charging the average of $1,500 a month for rent, but other buildings in the area are $2,500 a month. That's 40% more. So, so all we have to do, or 60% more. So all we have to do, because of the housing law and so on and so forth, is we have to empty the building, renovate the building, and then resell it as a different class of building, and that's it. And then also, and again, a regular landlord can't do this, but the venture capital guys can do. And we'll to make the town happy, we'll build some really low cost housing units 5 miles out. We'll put some, and we'll fill those up with cheaper tenants. And it's all just boom on the spreadsheet. But the bottom line is, think about the numbers, because if you've got 100 tenants and they pay $1,000 a month each, that's an extra $1.2 million a year you're going to wring out of a building. And if the landlord was making a profit, because don't forget there's running costs of the building, so the landlord who had been collecting $1,500 from 100 tenants, so he was collecting 1.5, and you're going to be collecting 2.5 million a month. Is that right? 1,000. I'm sorry, 200. He's collecting 150,000 a month. You'd be collecting 250,000 a month, right? So if the net profit of this landlord's building with the $1,500 a month tenants is maybe $200,000 a year, you can effectively buy his building from him by paying him $2 million on top of the value of the building. But then you're going to turn around and rent it out for $2.5 million a year. So even if you pay this guy $5 million, you're going to make it back in 5 years, 10 years, and show a big profit to your investors. And that all sounds great on paper, but you don't think about what it does to the tenants. What's it doing to the people who live in these buildings when you do that? But that's what's going on. So in other words, you know, the venture capital community realized that that apartments are generally underpriced, that the market could bear a higher price, and it was just based on some flawed modeling and based on having to get around the laws. And like I said, a single landlord can't do these sort of things. But once somebody with a big checkbook comes in, they can afford to leave a building empty for 3 months while they paint it and change the carpeting and so on and so forth. And suddenly they reface it and make it a luxury high rise, even though it's in the same neighborhood that it was before. You know, when it was called a tenement, now it's a luxury high rise. And all this, but what does it do to the community? It means the community is now, what's happening is the same 100 people who were spending, it's not the same, obviously, you're changing the people, but it doesn't matter. The people who occupy the building, who were paying $150,000 a month in rent. Am I saying that right? It's 100 times 1,000, it's 100,000, yeah, 150,000. So they were paying $150,000 a month in rent. Now they're paying $250,000 in rent. But what does that mean? That means that $100,000 a month that was available to be spent in the community is now being siphoned off to, and again, before the landlord was a local guy who lived in the community, now it's being siphoned off to some office in Manhattan. So just like when a franchise comes in, like when a Walmart comes in and displaces a town worth of businesses, the worst thing that's happening above everything else, aside from all these businesses being wiped out, is that the money that Walmart makes doesn't go back to the community. The money, that all the profit that Walmart makes goes to Arkansas. It doesn't do any good at all for your community. So they're killing the jobs, lowering wages, putting business owners out of work, and it's a lot of business owners. One Walmart will put out 50 stores, and those 50 stores all had a family or a key owner who had a $100,000 salary or whatever, and made a nice little profit. Maybe he was good for a couple of $100,000 a year. He's good in the community, so on and so forth. What Walmart does is they take all that and they knock down the prices, pay the lowest possible wages possible, and all those stores close down, all those landlords lose their rent, all those business owners are no longer business owners, and now all that money that used to be put back into the community is siphoned away to Walmart's corporate headquarters and the stockholders. And that's what kills the community more so than anything else. And it's a difficult thing to explain to people when you try to say, when you're saying to people in the community, this is why it's bad for Walmart to come in. It sounds good. They tell you they're going to create jobs, but they're going to create jobs that they're destroying somewhere else. And they're going to pay less wages than the jobs that are currently being here. Right? You know, you used to have Home Depot with the hardware stores. It's the same thing. You're putting out a lot of businesses. You're knocking out every local hardware store for 5 or 10 miles around a Home Depot. And yeah, of course, Home Depot is better than your local hardware store. I used to have a local hardware store, and I used to love going there, and he was a nice guy and all that. But the reality is, Home Depot's got like all these selections and cheaper prices, and they've got experts and so on and so forth. And that there's, to some extent, there's a slight benefit to the people buying the stuff. But on the whole, it would be way better if I pay an extra buck for a hammer, and all these other people still have jobs, and the money stays in my community, and so on and so forth, and builds things up. Instead, I save a buck, but I end up paying $3 in school taxes because there's no longer the base to draw. So everything is trade-offs, and this is unfortunately, and that's why, you know, these lobbyists, and they're also the most evil thing on the planet, but these lobbyists will get everybody to focus on the one thing and not the other. Look at this, don't look at that. That's how these things work. So rent cost, everything. Okay, so where are we? The Fed. Let's see what the Fed has to say. Well, first of all, let's see if there's any reaction. I doubt there is. It was so baked in. Marx, not UL. I don't know why there would be a reaction. There seems to have been a reaction, but I don't really get it. I guess it depends on what the statement actually says. Oh, look how nice that is. What is this? Fed officials boost inflation forecast by more than, I see. So they increased their inflation forecast. That's what it was. So it's not about the statement, it's about the rate hike. Full coverage of the Fed's policy statement and the 2 p.m. press conference. Fed lifted its 202 outlook by more than economists have been expecting ahead of the federal market. The forecasters had eyed a 3.5% forecast for core personal consumption price index from the 2.7 projection offered in December. Fed went further and now sees core inflation of 4.1. Holy, look out. So again, so I see. So it was 2.7. They had predicted 2.7. The economorons, the guys who predict this stuff, said 3.5, but it turns out to be 4.1, which is probably about 50% higher. So 50% higher than they measured it in December, and this is lowballing for sure. And overall inflation up by 4.3%. Relief, and it's going to last into next year. Way above where the Fed wants inflation to be. They've got a 2% target. We were talking about 4.3. So this is clearly a bad thing. So the Fed signals, okay, they're raising rates. Fed said it will lift rates, and they have further rate hikes this year. They stop the economy from overheating, and again, even with the war, even with everything else going on, the Fed is like, this is no good. This is not, we have to raise rates. They would raise rates for the Fed funds by a 0.25 percentage point to a range between 2.5 and 5 from near zero. Most of them projected pushing that level would have been prevailed before the pandemic. The Fed hinted at raising their concern about pressures. It said inflation had been high due to broader price pressures, and the war in Ukraine and related events are likely to create additional upward pressure on inflation. The rate-setting Federal Reserve approved the decision 8-1, so there was only one dissenting person. It was Bullard, who wanted it, and he dissented because he wanted a bigger increase. He didn't dissent because he didn't want an increase. He dissented because he wanted more. And I agree with Bullard. This is obviously, you're not going to do anything if you're only going to do a quarter point at a time. So look, it's been down here. We had the crash in 2008. We raised rates for a few years, and now we're right back to where we were in 2008. Now we're trying to raise the rates back up again. Let's see. Big revision higher. Okay, so let's just take a look at the FOMC. Not minutes. FOMC meetings. Okay, January, it's not January. Projection materials. Okay, here's what they're talking about. Let's start with the statement. Indicators of economic activity and employment have continued to strengthen. Job gains have been strong. Unemployment rate has declined substantially. Inflation remains elevated, reflecting supply and demand imbalances related to pandemic, higher energy prices, broader price pressures. The invasion of the Ukraine by Russia is causing tremendous human economic hardship. The implications for the U.S. economy are highly uncertain, but in the near term, the invasion and related events are likely to create additional upward pressure on inflation and weigh on economic activity. The committee seeks to achieve maximum employment, blah, 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 same crap they always say, inflation to 2%. Okay, the committee expects inflation to return to 2% and the labor market to remain strong. With the appropriate firming of monetary policy. In support of these goals, the committee decided to raise the target rate Fed runs from 1/4 to 0.5%, and anticipates that ongoing increases in the target range will be appropriate. In addition, the committee expects to begin reducing its holdings of Treasury securities and agency debt and mortgage-backed securities. So they're doing this, and they're going to start selling off their debt. They're going to start diminishing their balance sheet. So it's not just they stop buying Treasuries. They're trying to sell. They're going to compete with the government to sell treasuries and mortgage-backed securities and so on and so forth. That could get ugly. It depends on how fast they want to do that as well. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of the incoming information from the economic outlook. The committee would be prepared to adjust the stance if appropriate risk, blah, blah, blah. The committee's assessment will take into account, blah, 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 blah. Oh, that's it. So nothing. So it's not that. Now the projection materials. Economic projections of the Federal Reserve Board. Okay, so GDP. Let's start looking at some of these things. What is our GDP? Not very exciting. 2.8, 2.22, getting worse. In fact, going forward. I'm not sure what December projection means, frankly. Unemployment rate, they think it's going to be stable at about 4%, 3.5 to 4%. Oh, I see. This was what they predicted in December. This is what they predict now. So for this year, notice this, they've taken down the GDP growth from 4 to 2.8. That's 30% lower. They haven't changed their long-run projections yet, but they're knocking this way down. Unemployment is the same. The inflation is a massive increase from 2.6 to 4.3. The PCE inflation, oh wait, yeah. So the PCE and the PCE inflation, same thing. And the Fed funds rate, now this is really important. They were talking about a Fed funds rate of 1%, and now they're talking about 2%. That's a lot higher. At a quarter point, they have to have, well, they're at 0.25 now. Now they're at 0.5. So from 0.5 to get to 2% is 1.5%, and that's going to be 6 hikes of 0.25%. If they're going to sit there and do the 0.25, that's essentially every single meeting they have to hike. And then they're not done because next year they need another 1%. And that is how they expect to start getting inflation under control, but inflation is still going to be way higher than what they thought, even doing this. So they're saying, even if we do this, we're still going to get this. We're still going to have higher inflation than we thought. This is very bad. So that's what we're getting this reaction to. Oh, yeah, there you go. And so that's why we're getting the sell-off. But the bottom line is, none of that matters. What matters is that we got to 43.20 and we failed again. And we failed because of the things that were obvious. I talked about it this morning. I said, look, we were talking about the debt. So where was I? I know I was saying something bad. So I said we have the death cross, and that puts pressure. And then I said, what's going to save us? The Fed's not going to save us. They can't save us because of this freaking debt. And that's not. I don't know if this is going to translate. I'll see. National debt clock. So I don't know if it's going to go too fast for this to be resolved on the video. Anyway, so this number it says $30 trillion of national debt, $6.8 trillion of spending this year. So debt is 30 trillion, spending is 6.8 trillion. That's going to cause a 2.7 because collections of 4.1. It's not complicated. We are spending 6.8 and we're collecting 4.1. That means we have a gap of 2.7. Okay, when all these Congress people get together and they can't figure out how to balance the budget or what to do, and they tell you how complicated it is, it's not that complicated. You either have to spend less or collect more. They refuse to collect more, therefore they have to spend less. But when you look at the budget and you actually pull it apart, you realize that it's not really under their control. Oh, here you go. So of the spending, Medicare and Social Security are $2.3 trillion. The war, well, the defense is another $700 billion. And then the interest here, so it's 2.3 plus 1.5 is what, 2.8? Yeah, 2.8 and 3.8. So $4 trillion, $3.8 trillion is non-discretionary. You have to, or well, you could argue war is discretionary, but so 3.8 trillion though is the budget that in theory can't be touched. Now, what did I say about this though? This interest on debt, every quarter point rate hike the Fed puts in, and they just said they're going to do 6 of them, add 75 billion to this number. So we're going to have 675 billions is, I don't know, a lot of money. For another 4.5 is going to double. So the interest on the debt is going to double. So that means that this is non-discretionary spending for the government is more than we collect in taxes. Okay, it means we're living in fantasy land. We have an unrealistic budget. It's not possible to continue like this. You can't just run a deficit forever. So there you go, back to gold, right? This is why gold is a great long-term investment. This is unsustainable. You can't just ignore the fact that you're going further and further and further into debt. Every step you take is further into debt. And it's not a little bit, it's trillions of dollars. And we haven't even talked about money we need for climate change. If we spend $1 trillion a year on climate change for the next 20 years, it still won't be anywhere near enough. And I mean just the US. And every other country has to step in proportionally too. Where's that going to come from? All right, but if we don't spend that money, there won't be a planet. So then, then there's a good reason not to worry about the debt, though, right? Like, it doesn't matter, because if we're not going to pay any attention to climate change, there's not going to be anybody to pay back. It's a freaking mess. I'm sorry, but this is very, very depressing chart. Shouldn't really be looking at it. All right, so we're gonna wait. Oh, you've got to be talking by now. Let me see if I can make this thing work. La 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 la. Pow pow pow. Ooh. Okay. CNBC. We added more news coverage. I don't care. This is not CNBC. Bloomberg. Here's what I found. Just put it on. Freaking Android TVs. And that was a commercial. It doesn't make sense, so he should be talking by now. All right, let's do it the old-fashioned way. CNBC. Federal Reserve, blah, blah, blah. Continue without supporting. Thank you. I'm not going to support you people. Oh, no, the Dow's red already? Oh, come on. Wow. Wow. We were up 400 at some point. Oh, there he is. He's on my TV. As we noted in our policy statement, the implications of Russia's invasion of Ukraine for the U.S. economy are highly uncertain. In addition, from higher global oil and commodity prices, All right. Anyway, all right. So boring. Powell saying the Fed made good progress on the balance sheet plan. Yeah. Look, the bottom line is what I was saying this morning. They have their hands tied behind their back. You cannot ignore what's going on, but there's no good exit for this thing because at this point, everything hurts something. And if the Fed is going to raise rates, then the interest the government pays, and we're not talking about small amount. We're talking about $500 billion that the Fed is going to cost the government when they raise their rates. Now, the rates never should have been this low in the first place. We never should have had a budget that counted on having rates like this and so on and so forth. You can say whatever you want about it, but you're talking about a policy change that's going to cost us, and this is only the beginning, $5 trillion extra dollars over the next decade. It's not the Fed's fault. It's not their fault that we're going to suffer. It's not their fault that we have a $30 trillion debt that's going to increase by almost $3 trillion more, almost 10% more debt this year. That's not the Fed's fault. But this is a disaster. Oh, look, I'm using my favorite sound effect. So we are at the very early stages of a very, very major change in what's going to work in the economy. We've been living on borrowed money for a very long time, and as they say, it is now going to be time to pay the piper. And everybody has their head stuck in the sand, and everybody wants to pretend that's not what's going to happen. But this policy statement by the Fed, you read what they actually just said, and basically they're saying we have to start having a normal monetary policy. But when you think about it, if the Fed's not going to buy our debt, if the Fed's not going to buy the, where is that thing now? Now I got to go back to the national debt clock. Oh, I lost it. What did I do? Oh, it's here. That's why. Okay, so we have a $2.7 trillion deficit, basically $250 billion a month of additional debt. Additional debt. But that's not even true though, because this is based on this interest rate. But when this interest rate goes up, then this is going to go up also by $500 billion. And it's going to be 3.2 trillion additional dollars. And that's going to be, what, $300 billion per month that we have to borrow. We have not been borrowing $300 billion a month from the general public, from the world public, whatever you want to call it. We've been borrowing most of it from the Fed. The Fed's been buying all our bonds. Fed's been buying all our bonds, and now the Fed has a $9 trillion balance sheet of bonds. Now, that's also bullshit, though, because if you think about it, those bonds are bullshit. The Fed bought 30-year U.S. debt, 10-year U.S. debt at 1%, 2%, whatever the number is. That's this interest here. In reality, as the interest goes up, the Fed will lose money on their bonds. And you know what happens when the Fed loses money? It's a bill to the Treasury. So the trillions of dollars of bonds that the Fed has, if they have to roll them in for a loss, and so in other words, if the new bonds go up, their bonds lose value, and now of course the Fed is going. The goal of the Fed is to not turn them in early. They're going to let them expire and collect the cash and declare it that they made what they thought they were going to make, which was 1%. But the reality is they're going to take a loss. But if the Fed ever has to realize that loss, that also will add to our deficit. And this is the problem. We put it off and put it off and put it off, and now it's becoming a major situation. But this is something, I mean, nobody's talking about this stuff, and I don't get it. I don't understand. It's such an obvious thing. It's like this interest is based on the rates as they stand now. You know, on $32 trillion $30 trillion of debt, this is 1.5%, not even. That's what that number is. because 1.5 would be what, 450, right? So, this is less than 1.5% interest. If the Fed raises their rates 1%, it'll be 2.5, and if they raise it 2% like they plan by next year, it'll be 3.5, and this number will be $1 trillion more. And that money's not doing us any good. That's $1 trillion just to pay interest that we have to find, or obviously go more into debt to pay it off. But you can see where that's a trap. This is not good, and it's not being, and there's so much crap happening that I understand how people are distracted with other things. Well, look, see, he's such a good sweet talker, isn't he? Every meeting is a live meeting, he says. So in other words, he's talking about like how they'll be flexible. So as soon as he says that, the market pops back up. So this ain't over till it's over. We'll see what happens. I think I said that on Monday, right? I said it ain't over till the Fed lady sings, because you don't know which way it's going to go. But he is such a good sweet talker, but it doesn't last. He sweet talks the markets up, and then people go back to looking at the reality, and the reality is ugly. But certainly we have the ability. U.S. investors have the ability to completely ignore reality for incredibly long periods of time. And I'd say the most, if you want to call it encouraging, the most encouraging thing is that Japan has, we're 30, we have a 20 trillion, they're saying now we have a $22 trillion GDP, probably with inflation we do, but we have a $22 trillion GDP, we have 32 trillion debt, so we got about 150% debt. The encouraging thing is Japan is close to 300% in debt, and they still have a functioning economy. I don't know how, but it can happen. So the fact that Japan is still a functioning economy means we could probably go a lot more into debt than we are now. And like I said, fortunately, the world's probably going to end before we have to worry about the debt. And I don't mean in a good way. I mean in 20 years. But so if we can just keep ignoring this for 20 years, then it'll be back to the situation we got way bigger problems to worry about, because we've done nothing about global warming at all. And this Russia thing, oh my God, was it Maria? Yeah, it was Maria Bartiromo on some show I was watching. She was on, they were making fun of her, but they weren't making fun of her for this reason. But she was saying, why is the U.S. partnering with Russia on climate change? In other words, she's trying to make it like Biden's a hypocrite because he's working with Russia to disarm Iran, and he's working with Russia on climate change. And she goes, why would you work with this man? What is wrong with you? You've got to shut him out. And it's like, that makes no sense. It's a major world power, and we have major world problems. And you can't cut off your nose to spite your face. You can't say, I don't like Russia, therefore we're not going to deal with climate change. Russia doesn't want to deal with climate change. They want Siberia to become a tropical paradise. They're very happy with climate change. But we want Russia to stop polluting. We want China to stop polluting. We want China to go to net neutral, to go to carbon neutral. We need Russia to go to carbon neutral. If those two countries don't do it, there's really no point. Their economies are mostly China. China more so than Russia, but their economies are a huge portion of the global economy. Their output of carbon is a huge portion of the global total. You can't say, oh, except for Russia and China. So when she says we're partnering, we're not partnering. We're dragging these guys kicking and screaming into these things. Russia doesn't give a crap about whether Iran has nukes. But they've got to be part of a nuclear proliferation treaty. They're another nuclear power. Okay, you can't say I don't like you anymore, therefore we're not gonna have you be part of these things. That's crazy. Batshit crazy. But these guys will say just anything that'll twist anything to make it just negative on Biden. It's crazy. Look, Biogen lays out long-awaited Alzheimer's data in obscure journal. Oh, that's weird. Biogen on Wednesday published the full efficacy results from 2 late-stage studies of Alzheimer's disease drug Angelin in a lesser-known medical journal 9 months after the regulators cleared it. Cambridge Biogen has been under pressure to divulge the full details of the thing, which ultimately produced conflicting results. Big trials, high-profile drugs. Ooh, that's interesting. So I don't know, just for whatever reason, Biogen released all the results of their study in full detail, but they did it in an obscure journal. I don't know why. So that's interesting. Now, it doesn't mean you can't read it. So possibly they just did it to do someone a favor, to make him the guy who had it. Powell says the time for rate increases and balance sheet cuts has come. And the NASDAQ is still well up. The NASDAQ's up 232, but the other indexes have come, have not been performing as well. You can see that on the thing, but the NASDAQ is still pretty strong on the whole. But still, again, we're like so far below 14.1, it doesn't even matter. And the S&P, of course, we're still waiting for 43.20. We're not getting there yet either. We're going to cost everything. Randy says, do you have your got your passport updated? Randy says, to go where? It's a problem. Where are you going to go? It is not noticeably better in other places. But yeah, this country, I think honestly though, you can't, if you're a wealthy person, you kind of need an exit strategy for this country. You need to defensively set up positions, have set up banks. You have to do this stuff. It's not like you can make a decision tomorrow and get out of here in a few days, as you see with the Russians, right? These oligarchs and whatever. If you don't have a serious plan already in place, you are not going to get out. This Abramovich guy, he went to Israel and he was just there begging to be let into the country and so on and so forth. And they were like, no, not right now. Now, had he already established residency and so on and so forth and had bank accounts and whatever, great. Now, that's not good if they're going to seize your assets. And see, that's a problem too. When you start looking at foreign countries to go to, would you trust having your money in China? Because they could seize your assets as easily as Russia. We're seizing Russian assets, Russians seizing American assets, tit for tat. China goes to war with Taiwan, we'll be doing the same thing. So are you going to be good in Hong Kong? No, you're not. Are you going to be good in China? No, you're not. Where do you go? And a lot of countries like Thailand is a lovely country, but it's a military dictatorship. They can do whatever the hell they want. They can decide to seize your assets tomorrow. Is it likely? You don't know, because again, it goes back to the same thing. Global warming is changing a lot of stuff. We are no longer going to be food secure on a global basis. You're no longer going to count. We talk about world hunger, we talk about things like that, but it's not. We are not dealing with massive famines and things like that. We haven't had that in years and years and years. But we're heading that way. So you've got to really now start thinking about places that you might want to live in the long term if the U.S. becomes untenable. And at what point, let's say we try to address the deficit at some point. Let's say it becomes important. Let's say because of the U.S. risk of default, and it's like Greece, because we have a risk of default and so on and so forth, and we keep going into debt and so on and so forth, that rates start creeping up and the Fed can't control it artificially, and rates start going up 4%, 5%. At 5%, we're paying $1.5 trillion. I'm sorry, more than that, because that's the base rate, but let's say 5%. At 5%, we're paying $1.5 trillion in interest on the federal debt, on our debt. That's just our interest. So that means that close to half the money we collect in taxes is just being used to pay off the debt. Right now in Japan, 60% of what they collect in taxes goes to pay off the debt. Goes to pay, I'm sorry, pays the interest on the debt, not pay off the debt. Goes to the interest on the debt. So they just keep going more and more in debt, and the interest just becomes more and more of what they collect. At a certain point, though, you're going to pass 100%. If you keep doing that, eventually you get to the point where you're not collecting enough money even to cover the interest. Something's got to give. So at some point in the US, over the next 20 years, there's going to be a time when maybe they say, you know what, we don't have anything left to cut on the government budget. And the government discretionary budget is less than $1 trillion. So they may say, you know, there's nothing left to cut. We cut every department. We have no services. There's nothing. There's no Department of Education. There's no Department of Welfare. There's no Health and Human Services. We cut every single department. And believe me, if you put the Republicans in, they'll do it. But you cut every single department. Still not enough money. Still paying the debt. Still paying the interest. Now the lenders to America say, well, you guys are now at default risk, so we want 6%, 7%, 8%, and it's more money than we're collecting. At a certain point, some rational person has to go, we're going to have to tax people. Now, if you are only then, after they say we're going to hike taxes 20%, if that's the first time that you start thinking about getting out of the country, your money's going to be stuck. I guarantee you won't be able to pull it out without paying that 20% tax on whatever you pull out. So if you've got millions and millions and millions of dollars, and you're looking at getting hit with a 20% surcharge to move it down the road. So the time to start thinking about that is now. The time to set up a presence in other countries. The time to open up a bank account in Europe, open up a bank account in Singapore, something like that. Like, you got to find a couple of places where you feel comfortable having a secondary bank account. And it's tricky. It's hard. It's hard to trust people. It's hard to establish the thing. You want to get properties. You want to do certain stuff. You got to have law firms that you work with. All this stuff takes time and effort and money. It's just insurance. But it's a hedge against what could happen. And this shit could all hit the fan. Pay attention to what's happening to these Russian oligarchs, okay? And again, you think of them like they're criminals, but really they're people who a lot of them are not criminals. A lot of them are just business owners who were friends with the right people who benefited tremendously from the government largesse. But it doesn't matter. They're the ones that are up there in society, and they're the ones that are being targeted right now. And that can happen in China, that could happen in other countries, and eventually it could happen here as well, because the driving forces here are, economic and monetary, and it's a policy issue. And eventually you get backed into a corner. Powell is saying the American economy is still very strong. That's good. And like I said, though, we certainly can do another round of stimulus, and we certainly can drag this thing out for several more years. But eventually there's going to be a reckoning, and the time to plan for it is now, not after it happens, not after all the signs are in place. And worse comes to worse, is when you leave your estate to your children or whatever, and instead of having just all your money at JP Morgan, you'll have your money at JP Morgan and at Credit Suisse, and you'll have some money at the bank, you have some money with Mitsubishi or something like that. You'll have your money spread around, and you'll have different investments in different countries and so on and so forth. That's that's the worst exit. But just be very careful. I mean, make sure you make sure you check out anybody you go investing with in foreign countries, and everything you do, because there's so many ways they can screw you. But on the other hand, there's so many ways you can get screwed if you don't do that. So very tricky. So be very careful out there. As you can see now, we're popping right back. It's a little hesitation, but like I said, Hal's this great sweet talker, but we'll see if this lasts. And again, that's why we go back to that chart all the time, because what matters is, did we or did we not make any progress? It doesn't matter what the intraday movement looks like. What matters is this: did anything change here? Okay, And so is the NASDAQ over 14.1? No, it is not. Is the S&P over 43.20? No, it is not. It doesn't matter how much zigzagging it does. The answers are very simple. No. All right. So 1960 was the weak point. Look where he came out. 1960, 1970. So the Russell held up right at that same spot again. So it's good on the Russell. It held their line. NASDAQ 13.5, remember, is the 20% correction spot, and that's right where he turned around at 13.5 for a bounce. And this, I don't know, this is nothing. And we're looking for 43.20 on the S&P. It's the most important line right now. But it won't take much. Now it's going to be commentary and so on and so forth. But once people start realizing the Fed swaps show around 75 basis points of what? Of hikes over 2 meetings. Oh. So now the Fed swaps are showing that they expect to hike at least half a point in one meeting and 0.25 in the next meeting. Oh, so crazy. So anyway, so we'll see what the commentary kicks in on this stuff. And Vizvev says, what is your take on Didi? The stock dropped almost 50% earlier in the week, and they seem to have issues with the Hong Kong IPO. They're all over the place with the regulations and so on and so forth, and China's taken exception to them. So I don't think I don't think I would be risking it on Didi right now. We were in them for a while and we gave up because it just wasn't it just wasn't really something we wanted to what the heck? Hang on a second, sorry. It wasn't something we want to take a risk on. There's too many moving parts with Didi. I think, you know, as a risky thing, I mean, you said it dropped almost 50% early in the week. Yeah. They've been all over the place today. Let's see where they are now. Not futures, chart. Didi is the Europe of Asia. Oh, look at that, 50% jump. But it's all the uncertainty, and mostly it was the regulation by China and the way they were treating them. And China just said they said they'd be supportive, not necessarily specifically Didi, but this was read into it, and it was so oversold. It was just ridiculous. I mean, they're treating it like they were going bankrupt. Meanwhile, they're a functioning company. But again, that's the problem, though. They cast their lot with China, and they're trapped, and then China turns against them, and they're screwed. That's the same thing, right? You're casting your lot with America, and if America turns against you, you are going to be screwed. You guys need, you know, the people who have a lot of wealth need to seriously consider you know, what their exit strategies are. You got to protect yourself, and you got to protect your family, because we don't know what's going to really happen here. You know, Powell always gets a good boost out of the market. But right now the Dow is up 0.3%. I mean, it's really the S&P is up 1%. The NASDAQ is kicking ass. It's up 2.25%. But the NASDAQ's kicking ass because you got companies like Didi, you know, you have companies like Didi that are up 50%. Freaking these Chinese companies. Look at Alibaba. Alibaba's up 31% today. And then you got Baidu, 30%. Freaking 30%. Isn't that crazy? And the last couple of days we were talking in chat about Alibaba. We have it somewhere. And I said, look, I said, at this point, I don't see how we could, I said, frankly, I don't see how it could go lower. So why would we get out? It doesn't make any sense to capitulate when you've been holding it this long. But I also said I didn't want to put more money into it, which is kind of a mistake, but that's okay. But it was in the long-term portfolio, I guess. La-di-da. Here we go. Holy crap. Wow. So long-term portfolio came right back. We're at 2.2. We're at 2.2 again. Wow, we were down at least 100,000 yesterday. Wow. Oh yeah, see, changed today, 127,000. Wow, that is just crazy how that snapped back. I'm gonna say it's all Alibaba, but partially. Oh, and that's not even counting Rio. Wait. Where's Rio? Rio. Yeah, Rio had some sort of a thing that has to be adjusted. Baba. There you go. We have $140 calls. They were getting completely crushed. So big change today. In fact, look, they're up $23 today. Or I'm sorry, the stock's up $23 today. I don't know what oh, here it is, 9. So these calls have doubled today. They're up 100% today. So we were down $72,000. Now we're down $38,000. That's a big help. So and the puts have lost, and the puts are down 24. So we were down. This was down 24 more dollars times 10, so $24,000. We shaved 24,000 off these puts, and we shaved 75,000 off here. This is most of our gains is right here in Baba. We have already spent money and rolled and so on and so forth, and I didn't want to put any more money into it because it was just getting ridiculous because it's been such a big losing position. And I said it's either it's going to turn around and this is going to get resolved, or it's not. Plus, we have until 2024. And if you think about where Baba came from, where I think we just did that, right? No, Baba. Think about where Baba came from. You know, they're down from 180. So if they get back on track and start moving higher, and this is yeah, I'm sorry. So there was 180 earlier. There was a short-term chart down from 250. So we have the 140 calls. So if they get back on track and they get up to 200, that's going to be a pretty amazing position. Now, originally it was a spread and it dropped, and we brought back the short. We brought back the calls. I think we probably rolled it down to this position. You know, we've had this since December. I think this is a roll down too. We probably had a higher strike at the time, and so you know, but it's a big position. We've spent 113,000 there. We sold the puts, so we spent $80,000 on the trade, and now it's currently minus $25,000. So we're down $100,000 on this position. Well, you can see it right there. We're down $100,000 on this position, but if it turns around and gets back to 200, then this is going to be 240,000 on the plus side, and these will expire worthless, and we'll make $340,000 turnaround. So you know, right now it's negative 100. I'm sorry. Right now it's negative 25, and if it goes up and we get to 250 here, we'll be positive 275 total. So the 25,000 losses erased plus the gains recognized. So this could become a massive position. And I'm sorry, it only has until 2023. So we're probably going to end up rolling it. So when the 25s come out, we're probably going to roll these to a 2025 spread of some sort. But you know, it's got the potential to be massively turned around. This position has been hurting our portfolio. Hitting it by 5% of the total portfolio value has been lost. And somebody asked me the other day, do you want to capitulate? You know, you want to give up on Baba? I'm like, I said, what's the point of giving up now? There's no point in giving up. I said at this point, I don't see how you can possibly say they're not worth this much money. And that's the thing. A lot of people do that, and I don't really understand it, because it's like, you know, a stock is being priced as if they're going bankrupt already. Why should you get out then? That's, you know, you know, just to avoid losing the last, you know, out of a $10 investment, you have $1 left. So to save the $1, you're gonna get out after you sat there for $9. Doesn't make any sense. Obviously, you're still in it because you think it's going to go from 1 to 5 and at least get half your money back. So since my upside is getting to 5 and my downside is losing $1, it's a pretty good bet, even if I think the odds are against me. And I'm not saying that you do that with everything, but in this case, it was about China changing the regulations and cracking down on tech and so on and so forth, and that's fine. But there's a there are repercussions to that, and the repercussions were becoming for China. You know, Alibaba employs 1 million people, or whatever the number is. But Alibaba, you know, Alibaba is like Amazon; they employ tons of people. They're a huge employer. They have a lot of high-paying tech jobs, and Alibaba's saying, "Well, I guess we're gonna have to start shutting things down. If this is your regulation and we can't run a profitable business, then we won't run a profitable business." You know, and Jack Ma's a multi-billionaire. He's like, I'll go do something else. I don't give a crap. I mean, he doesn't care, but you know, same thing with Bezos. You want to say that you want to screw up Amazon? At this point, Bezos has $200 billion. He'll be like, well, that sucks. And maybe he'll end up only having $100 billion because Amazon craps out. He's still going to have $100 billion. There's a limit to how much you can screw somebody when they're that rich, and that's what a lot of governments are realizing, is the ultra rich have way too much power. But it's too late. There's too many of them. All right, let's call it a day. So that's where we are, and we will see what happens. Basically, just keep a very sharp eye. I mean, we still haven't got a resolution, so we're going to keep a very sharp eye on where the S&P is at that 2320 mark. But it's not. That's just a, you know, again, that's just a technical. What matters is on the bigger picture. There's the death cross that the S&P is making, which we talked about this morning. We talk about everything in the morning, don't we? Whoop, not that. This death cross. See, and again, how will this be resolved? How will we get out of this? As long as you're in a death cross, as long as the 50-day moving average is below the 200, you have downward pressure on the market. So how does this get fixed? Well, the only way the 200 could go lower is for these to stay significantly below the 200. That means, unfortunately, though, that the blue line will keep getting pulled down. So that's not going to happen. So the only way to get the death cross back over is for these candles to go over the 200-day moving average, which will then start bringing the blue line back up. So they have to, you won't be out of danger until these guys are over 4,500. That's quite a long way to go. It's almost a 10% move up in the S&P, and that's still not getting you anywhere near the highs. We are significantly down. So at this point, 10% up is only going to get you to the zone where you're going to test the 200-day moving average. That's bad. No, I'm sorry, this is 5%. This is 5, all right, so 5%. The 5% move up is only going to get you into the zone where you're testing. Now today, this is not reflected here. We're at 43.20 or 43 now. But we have to have several more, right? So in 2 good sessions, you go from 42 to 43. There's 100 points. So a couple of more good sessions, 44, and another good session to get you to 45. So you're talking about, or another 2. So you're talking about 4 solid, powerful sessions like we just had have to happen without a downturn, without any pauses, without any pullbacks. Does that happen? Well, here's 4 powerful sessions in a row. So it does happen. It can happen. It did happen over here. And that's exactly what helped in January. That was a big help, right? So it can happen. But what's going to happen? Well, then you look at what are the concerns. You got the supply chain concern. You have the China's in the shutdown. You've got the Fed raising rates. That's a given now. So we'll see. And that's the thing. Now you say, okay, well, the Fed raising rates is now in the past, and now we look forward. Okay. I've seen if Powell said anything new. What catalysts are going to change? So what's going to change? And as I said, what's going to change is now we're going to look at, unfortunately, Q1 earnings. When all this shit was hitting the fan, the higher inflation, the supply chain problems, the Russian war, and the China shutdown. This is all still happening in Q1. And in April, they're going to start telling us how badly that impacted their business. And that's right when we need this thing to be taken off. So it's not likely. And if it's not likely, it means we're probably going to spend a prolonged period of time below the 200-day moving average. It's going to be very hard for the 50-day to resolve itself. All we can hope for is it flattens back out and this has a chance to consolidate and we can move higher. But again, given what I see now, given what I hear, given what we expect out of earnings, I think we're probably consolidating for a move lower. So don't want to be the bearer of ill news, but that's where we are. And like I said, I think we have another stimulus in. Otherwise, I'd be shorting the crap out of this market. But I think there will be another stimulus before we're allowed to move lower. But after that stimulus, I'll start cashing things out. We get back to these highs, and I'm going to take that money off the table and run. Okay, because there's a lot of things that can go wrong right now. And I'm not to mention, of course, at any second, there could be several ways where the Ukraine could get so much worse. Okay? Chemical weapons could be used. An accidental nuclear emergency could happen at 2 major nuclear plants in Ukraine. Well, Chernobyl is currently being, on life support because they screwed it up. And the other big reactor, they barely missed it last time. So all it takes is one errant missile and you have a nuclear crisis. All it takes is one actual nuclear missile. Think if Putin, hopefully Putin's not like Trump, but think about if Trump were this pissed off and a war wasn't going his way. Trump wanted to nuke a hurricane. Let's put it that way. Trump asked scientific advisors if it was possible to drop a nuclear bomb in a hurricane to disperse it. And they said, well, A, that's probably not going to help, and B, it's going to disperse nuclear material all over the world. So that's if Putin is that crazy and he decides that a nuclear, look, you drop a nuclear bomb in Kiev, it doesn't matter where Zelensky's hiding, or whatever his name is. Anyway, it doesn't matter where he's hiding, he's screwed. Okay, so wherever you are in Kiev, everyone in Kiev is dead. Russia makes a massive statement saying, don't screw with us. And what's the rest of the world going to do? Okay, they could also launch a coordinated attack where Syria and Belarus forces get together and they start attacking, and they do a major assault on Ukraine because Putin badly wants to win and not be embarrassed by this whole thing. All that shit could happen. At the same time as all this economic stuff could happen, the virus in China, which is spreading through China and is already being seen in Europe, could end up coming here. And it was like, oh no, that would never happen. A virus in China coming here? What's the chances of that? So there's so many things that could still go wrong. And it just drives me crazy when I see the markets like popping on stupid news, on nothing particular, nothing that great. And they just, because people want to buy, they want to be bullish. But again, like I said, the first thing we did this week is we checked our hedges and we made damn sure we had plenty of hedges. And that allows us to take a little bit of a bullish chance right now as we're making our adjustments, because hopefully we're going to get a bounce. But there are many, many things that could happen that will make us suddenly have to cover up. And that's the good thing about the way we're doing it. We're not putting more money into positions. What we're doing is buying back short calls. And the bottom line is, though, if it goes wrong and things start going lower, what we do is we sell more short calls and maybe even tighter short calls at lower strikes. So we're not making a huge bullish move. It seems like we did a lot of bullish things in that portfolio, but they're all fixable very fast by just selling more short calls. We're just opening up the slot so we can do it either way. But if it goes up, great. Then we're still going to sell more short calls just at higher strikes. If it goes down, we're going to sell short calls at lower strikes. So don't mistake what we're doing for some bullish endorsement of these positions. We're just taking advantage of the sell-off at this point. But if that sell-off continues, things can get very, very ugly, and we're going to have to, I think I mentioned that earlier in the week. I don't know that the hedges are going to be enough, or it won't be worth holding on to all these positions, even if the hedges are enough. And we may have to start liquidating. So again, always have an exit strategy just in case. All right, thanks everybody. We'll do it again next week.